Good morning, everyone. Welcome back to another weekend workshop. I'm so excited that you've joined us today, middle of summer, but we're talking mortgages. And this is a very timely topic, whether you're thinking residential or commercial space. So today we're so thrilled to have Alex and Courtney here to talk to us a little bit more about some of the secrets, some of the, the hidden tips and thoughts and tricks, philosophies, whatever, around finding the mortgage that's right for you, and even probably discussing what time is right. So I'm just so glad that you've joined us today. Welcome. For those of you who don't know me, perhaps have not met me in the past, my name is Carrie Ramsey, and I'm the project manager for the Weekend Project, which is led by Queen's University and funded by Queen's Partnerships and Innovation. So it is, we've done many of these, of course, over 100 at this point. And each one, we were just talking off before we hit record that there's just so much richness and depth to this weekend community in terms of the people who support us and share their wisdom. And then, of course, the questions and the curiosity that you all have. So I hope that you will engage today in the Zoom chat. There will be some time for questions at the end. But if you have a burning question, use that Zoom chat and we'll try to get those questions answered as we go. So while we're just waiting to get started here, I know there will be some others joining us. Why don't you take a moment in the Zoom chat to let us know where you're connecting from and let us know what your business is. We always do like to give you the opportunity to sort of share a little bit more about yourselves. If you have a link that you would like to drop into the Zoom chat, by all means, feel free to do that. And while you're doing that, I'll take a moment to acknowledge that Queen's University is situated on the ancestral territory of the Anishinaabe and the Haudenosaunee peoples. And so working together with women entrepreneurs is such a huge joy for me, and really getting to celebrate the different history, culture, heritage of all of the women entrepreneurs that we serve is also very rewarding. And of course, this only comes when we honor and respect each other's heritage. So in particular today, I'd like to acknowledge the Indigenous peoples whose resilience, culture, and business philosophies have been such an important part of our shared history. So thank you so much for those of you who are taking a moment to introduce yourselves in the Zoom chat. Courtney, I believe you're going to be kicking it off today. So I would love to hand you the microphone today and just let's jump right in. I know we've only got about an hour together today, but let's get into all the juicy details. Over to you, Courtney.
Thank you. That's wonderful. And thank you all for the opportunity to speak to you about mortgages for self-employed women. And I have Alex with me as well to talk about commercial mortgages too. So if we can move to the next slide there. Basically, I'm going to introduce who I am and what we'll discuss today. Sliding over, there we are. So why the mortgage industry? Basically, I was in it was COVID times, July 2020. I had just recently got divorced. I'm trying to go back to work. I'd moved to Ontario from Alberta. I had so many friends in the real estate industry as well. And they were encouraging me to go into real estate too, but I kind of like the paperwork and the numbers part. So I did look at being a mortgage agent. I initially joined in the broker channel with Citadel Mortgages. It was basically a national mortgage brokerage that was across the country. One of the funnest mortgages I did was in Tuktoyaktuk, so that was pretty interesting. And I quickly became part of their leadership team, and I was training other mortgage agents who were just new to the field coming into the industry. I did love training people, love talking about mortgages, but I also really missed helping clients directly. So I did make the move to CIBC last fall. I had heard from a lot of previous people that I had trained myself that they really enjoyed CIBC when they moved on. So I did go there. They do have a lot of products, especially for self-employed people. I find that they're really great for self-employed clients. So about our presentation, it's all CIBC branded, but because banks are regulated through OFC, all of this information will apply to whatever bank that you're currently with as well. But also I'm going to encourage you, of course, to move to CIBC with me. So we're going to go over the types of self-employment. We'll talk about types of businesses, and we'll also touch on Indigenous mortgages as well, because they are a little bit different. We'll look at the math behind the qualifications so you understand what's going on behind the curtain. And we'll talk about some tax discussions that you could talk with your accountant and products that you may want to consider. After I'm done with the residential and self-employed mortgages, Alex is going to take it over for alternative lending solutions as well as commercial loans. So the first one we'll go over is self-employment types, because this will affect your type of mortgage that you get, and also the documents that you need to provide your mortgage advisor. So the first two is sole proprietor and general partnership. They're basically the same except for how many people are involved. So a sole proprietor, it's you're unincorporated, you file your business taxes through your personal taxes, you don't have any partners, so you're 100% responsible for the liabilities, but also 100% responsible for those profits as well. With a general partnership, it's basically the same thing, except for now you have 2 or more people involved in the business. You're still not incorporated, but you may have a verbal or written agreement about how you profit share or liability share. The important part for both of those things is that you do file your business taxes through personal taxes and not a separate company taxes. Then the last two is limited companies and limited company partnerships. They are the ones that are incorporated. So you're not personally liable for the losses. You do a separate tax filing from your personal for the corporation. And the partnership is just like the above, except for now the ownership is divided through legal means through general partners and limited partners. So after we figure that out, the next step is to get some documents and also to calculate your income. So for sole proprietor or general partnerships, we're going to ask for your T1 generals. Those are the paperwork that you fill out to submit to the CRA. So we're going to want to see those because it does detail how your income is being recorded. So we usually ask for the first 8 pages of them, but we could also ask for the business details, or if you have agricultural or fishing income as well, there is another page further along in the T1 package where we could ask for that as well. We do ask for your 2 most recent notice of assessments as well, and how we calculate your income. And this is where you can find it important for your planning purposes, is that we use the average of 2 years of your notices of assessments, and then we add back 15%. So we take that average and times it by 1.15. This is because we know that people write off as much as possible. So we add back a little bit of that amount to increase your income a little bit. So for discussions for accountant, we need to plan ahead for your mortgages a little more so than salaried income employees, because we're looking at a 2-year average. So if you write off everything possible and you have a low personal income, it might not be beneficial for you for your mortgage. So when we talk to our accountant and we're making plans for our renewals, refinancing, taking out equity from our home, that kind of thing, we need to look at the 2-year average. And is this going to help you with your mortgage or disqualify? So then in our next one, this is limited companies, so they're incorporated. So we're going to ask for your personal taxes as well, because this is, again, where we're finding your income is on your personal taxes, but we're also going to look at your business. So we're going to ask for a lot more documents. We're going to look at the first 8 pages of your T1 generals. We're going to do that average, the 2 most recent NOAs. It's the same as sole proprietor, except for now we're going to ask for your corporate notice of assessment, as well as T2s. So that's like the T1 version, but for corporate, or finance statements prepared by your certified accountant. And so we're going to look at that for 2 years. We're going to do the same calculation. So 2-year average, 1.15 multiplied so that we can get the tax write-offs there. And then the next slide, please. So why we're looking at the additional documents is because if your business is showing a negative income, we're going to want to know how you're going to maintain your own salary and your own income if your business has a negative income or a lower income. Again, we understand that corporations will write off as much as humanly possible to avoid taxes, basically. So we do have to have like a pretty good story about that. We can also include dividend income. So if you're not drawing a salary, we can use dividend income instead. It's a 2-year average, the same as the notice of assessment. However, last fall, we removed capital gains. So capital gains income is no longer allowed. So that's something to talk to your tax accountant with, if depending on how you pay yourself with your self-employed income. So the next one, so with that limited company, because we're seeing like the negative balance perhaps on your spreadsheet or something like that, what we can do is mitigate your income. And this is called net income after taxes. So we can basically add back some business income into your personal income to increase that amount. It cannot be your sole source of income. This is mitigating only. So you do still have to pay yourself. Make sure that you're paying yourself. Personal taxes, like paying income taxes, nobody likes doing it, but it does help you when you're looking for the equity in your home. For net income after taxes, we can only use this if it's a refinance or you're putting more than 20% down on a purchase. This is because if you have less than 20% down, then we're going to have to go through default insurance companies like CMHC, Sagan, and Genworth, and they don't accept this type of income, so it would not be allowed. You also have to own at least 50% of your company and have financial statements from a chartered accountant, not just the T2s. You do need to have financial statements with a chartered accountant. And the reason why is because we'll take your financial statement, it's on the next slides, Alex. We'll take your information prepared by the chartered accountant and we put it into a very fancy calculator. It will basically take your revenue minus your taxes and expenses and spit out a number that we can just add right back to your personal income. So this can be very beneficial if most of your income is left in your business rather than paying yourself, and you are looking to refinance or you do have a sizable down payment. So this is a great discussion to have with your mortgage advisor, just to make that plan of how to pay yourself and what you can kind of qualify for before you go ahead with whatever you're doing with your accountant. So let's also talk about the types of businesses, because I know that you fill out an application, it's all about the numbers, it's all about the income. But in reality, when we take your file, we actually have to create like a story, basically. Who is this person? What does their business do? How is this a great person to work with? That kind of thing. So we're looking at, I'm going to ask you questions about your business. Like, is this a service? Are you providing goods? Are you doing both? How is it structured? How do you earn your money? That kind of thing. And then also, we should touch on higher risk industries. So when banks see a higher risk industry, so we're looking at import export or foreign income from flag countries, that type of thing, or also sex work like OnlyFans and subscription services like that, the banks are going to be flagged through anti-money laundering or anti-terrorist funding regulations. So that's a higher risk. I know there's a lot of talk about banks not wanting to associate with those types of industries and things like that for historical prudiness, basically. But actually, it's because we're going to have to explain to the government why this is okay, and that this person is okay and not being trafficked or harmed in any way, and we're not dealing with terrorists or anything like that. So it could be flagged. So when you have a discussion with your mortgage advisor, if you do have a higher risk industry, we need to know the ins and outs of everything about your business. So expect those kind of questions. Then we also have a very popular industry now is the short-term stays and, rooming houses, in-home respite care. They're sharing our home basically to make an income is becoming ever more popular because the cost of housing, frankly, is just insane right now. So from the lender's viewpoint, this is a higher risk property. So the income, we're looking at income being predictable and ongoing. And when you have short-term stay rentals like Airbnbs, VRBOs, or even just your own private, you let people camp in your backyard, they're not seeing that as predictable or ongoing income, especially when we have changing laws surrounding them and cities actively trying to get rid of them as well. So if they're actively trying to get rid of these type of industries, then that income is going to be damaged as well. Then also you're looking at rooming houses. Student houses generally have a lot of damage and depreciative value, and that makes the bank nervous, right? Because like if anything, they're always looking at the worst case scenario. If anything were to happen and you were to foreclose, how can we sell this property and not lose money? So that's the lender's viewpoint. So that's where we come in as mortgage advisors and mortgage agents, is to tell your story to mitigate these risks. So we're going to ask a lot of more questions, not just documents. Tax discussions for that part is to consider perhaps your short-term stays or your in-home respite care, anything like that. Talk to the accountant about possibly putting this as business income rather than rental income. So there are some tax implications for that. Rental income often has a little more write-offs that you have available to you, but business income can be included a lot easier than rental income. So that's a tax discussion you should have with your accountant. I'm definitely not an accountant, so speak to them
Courtney, can
about
I
that.
ask a quick question just on this?
Absolutely.
I'm thinking of a couple of our clients who have, so they have, and I don't know if this applies to commercial as well, but they own a commercial space or they want to own a commercial space and rent out parts of that commercial space for like people who have a booth, for instance. If it's a creative space, maybe they have makers. And so is this applicable as well? Is this kind of the idea of sharing a commercial space?
That would definitely be about commercial business income. So that's like a commercial space. I'm speaking solely about like residential
Okay.
properties. Yeah.
Gotcha. Okay.
Yeah. Okay. So moving on, I wanted to touch base on Indigenous mortgages as well. This is from the Indian Act of 1876. So it's very old, outdated, and, the good intentions pave the road to hell, right? So basically in the Indian Act of 1876, they decided that any property of an Indigenous person, their property could not be subject to charge, pledge, mortgage, attachment, levy, seizure, distress, or execution in favor of anybody else. What this meant for Indigenous communities is that they could not get a mortgage. They could not access the equity in their properties whatsoever. Because when we have a mortgage, we're putting a charge or a lien against our property. It's sort of like car insurance, right? If you get into a car accident, the first person that gets paid is the company that you've leased or financed your car through. It's the same with banks. So this really lowered the ability for Indigenous people to grow their communities and to use the equity in their home to grow their communities as well. Finally, in 1966, the Department of Indian Affairs and Northern Development was granted authority to provide ministerial loan guarantees. So this is the same as default insurance, like through CMHC. CMHC does have this, and I do have a direct contact for that. So if you do want to mortgage an Indigenous piece of property or a house at all or anything like that, or purchase that, if you are an Indigenous person, there are mortgage loans available to you. Unfortunately, it still does not include collateral charges, and that means that you cannot get a secured line of credit. So hopefully in the future, they do make changes surrounding that as well. But we do handle Indigenous mortgages as well. If you're a non-Indigenous person purchasing property on reserve land, that is a whole different aspect. And unfortunately, there isn't really kind of mainstream bank lending for that kind of thing, just because of the property lease agreements. So that's more of a conversation to have with Alex. For self-employed Indigenous people on Indigenous land, the documents are basically the same. We're going to ask you the same questions about your business. We're going to ask you for the same documents. It's just our math is different. So for sole proprietors that are living and working on a reserve, the add back is a little bit greater, just to kind of offset the tax implications for Indigenous people. So if your income is under 30,000, we're going to add back or 1.25% instead of 1.15. And if it's over 30,000, then we're going to add back 1.35%, or sorry, we're going to multiply it by 1.35 over the 30,000. So the limited company net income after taxes is the same calculation. So if you do have a limited company and you're living and working on Indigenous land, that's the same process there. So we finally have your income. We figured it out. Now what? So this is the math behind qualifications. The biggest part is figuring out the income, proving that income, and then we go to do the qualification math. So we have two ratios. The first one is gross debt servicing. This is all about your housing costs. So we're going to look at the principal and interest. So that's you're paying down the principal of your mortgage plus the interest cost that's going to the bank. We're going to look at the property tax and the heat. So those are all monthly liabilities that we're going to look at first. We're going to divide that into your income, and it needs to be below 39%. The next one is TDS. That's your total debt servicing. So we're including PIF, which is principal and interest, property tax, and heat. And then we're also looking at monthly liabilities such as credit cards, car loans, lines of credit, student loans, alimony, child support, etc. So your monthly liabilities plus your housing costs, and it has to be below 44%. One thing to consider when you are doing a mortgage application with self-employed income or just even salaried income is that there's other types of income that can be included as well, such as child support, alimony, rental income for long-term legal properties, foster care income, investment income, pensions, disability, even ODSP can be used as a mitigating source of income as well. So now that we have these ratios, when can we bend the rules? Because some of them, sorry, we're still on the same side, Alex. Some of these rules can be bent at the branch level. So when we have more than 20% as a down payment, or you're looking at refinances, then we can kind of bend the rules for this qualification. This is because we don't have to go through CMHC, Genworth, Sagan for default insurance. The GDS is very not likely. That is your housing costs. We want to make sure that you're not house poor. So that's a big one that we do kind of stick to a lot. The TDS, we're more likely to bend that rule, and it really depends on the client's situation, and that's where it gets back to making sure that you have that solid conversation with your mortgage advisor about your story and to get that story out there for you. We also have banks, all of them have a customer relation index. So this is how franchised you are with the bank. Do you have other loans? Do you have investments? Do you have other products with us where we're kind of making that money there too? And we can also see that you are kind of like a reliable person over time. So whatever your case is, we try to argue this. Mortgage advisors are like the middleman. Even though I work for CIBC, I'm actually working for you and arguing with CIBC to get you this mortgage. So that's sort of like my job. I want to make this great story. I want to get you approved. It's why I'm not in underwriting, because I would just approve everybody. That's why I'm the mortgage advisor. Okay, so our next slide.
Courtney, just before we move on, there's going to be a couple of questions in the chat. So here,
let me
I'll throw them at you. And you can let me know if this is going to be covered later or if you'd like to answer now. So Stacy's asking, how is existing mortgage debt? Oh, I think there was one before that. Is the calculation different for a second property that will be used as an investment? That's the first question.
So for a second property that's used as like a rental property, we're still going to include the principal and interest cost, but we're also going to include the rental income. So we have something called a fair market rent assessment, where we'll go out and we'll decide how much rent you'll likely get in that situation. So it kind of like offsets that. We also have a program that if you have more than one rental property and we're refinancing or purchasing another rental property, we have a rental offset calculator, which basically makes your GDS and TDS a lot more flexible. I've had a client where it didn't make sense at all with the ratios, but as soon as I used that rental offset calculator, the ratios were great. So there's lots of flexibility with investment properties and rental properties as well, to include not only the income to offset the liabilities, but also to like kind of make the numbers look more good, basically.
Okay. So the second question here, also, how is existing mortgage debt and HELOC, I don't even know what that is, calculated for a second mortgage on a new property?
Sure. So if you're looking to refinance the mortgage and the HELOC into a HELOC, by the way, just so that everybody knows, is a secured line of credit against your home. So it's like having a credit card, but it's secured against your home. So it generally has lower interest rates than a credit card or a personal line of credit. So if you're refinancing a secondary property with a mortgage and a HELOC, we're going to look at the new cost of the principal and interest rather than the old cost. If you're using it as like, I also have this property and I'm refinancing this, then we're going to use the current cost of that.
Right, so hope that answered that question. And then the final one here, how does B lenders and credit unions compare for self-employed persons?
That's a great question. I'm going to let Alex answer that. I used to be in the broker channel, but we have Alex here to discuss alternative lending, also known as B lending and
Do you want to
commercial
hold up
lending as
that till
well.
you're part of the presentation, Alex? Is that something you're going to be covering?
Yes.
Okay,
Yes, yeah, that's something I'll be covering
right. So
shortly.
we'll just park that one for now. Okay,
It's a
thanks,
great
Courtney.
question, though. It's a great question. So let's talk about rates. Everybody wants to know about rates and how those things are going. And so variable rates is the first one that I like to talk to. I'm a variable rate person, even with Bank of Canada raising the overnight rate a lot. Right now, the prime rate is at 7.2%, which seems quite high. We did have this high of a rate. The last time was in 2006 with the start of the whole subprime mortgage crisis that was generally felt in the US, but we also had kind of like a inflation and recession crisis in Canada as well. Before that, it was in 2000. We had the stock market bubble crash and the Bank of Canada raised rates. So people are upset about the rates now, and understandable as I get it, but also we have weathered these types of prime rates before. And if you look at the historical values of variable rate and you're looking at paying something cheaper overall on your mortgage, variable rates do offer the less interest cost overall with your mortgage. They also have other benefits where if you needed to refinance or sell your property or anything like that, you're looking at only 3 months of interest penalty rather than a fixed rate, which is calculated as an interest rate differential, which is a fancy way of saying they're going to make you pay the interest for the rest of your term. So it could be a quite large penalty. When I had to sell my house after divorce, I paid $14,000 in penalty alone. So if you are thinking of maybe selling or maybe downsizing or anything at all in the next couple of years, or halfway through the term of your fixed mortgage, maybe consider a variable rate mortgage as well. So then we're looking at fixed rate mortgages too. Fixed rate mortgages offers you more security in that what the rate is the whole time. So during COVID times, the people that opted for 10-year 3% mortgages, they're laughing right now because the mortgage rates have gone way up since after COVID because of, just global crisis in general. So our CIBC rates right now, they're between 5 and 7% for fixed rates. So that's quite high. Pre-COVID, it was like in the threes averages. So we have to look at how long are we staying in our house? How likely are we to refinance? And can I afford a little bit of movement with variable rate mortgages? So the other thing I wanted to talk about is posted rates versus base rates. So this is the secret for banks. We have our posted rates on our website, but that's not the rate that I can get you. I can get you what's called the base rate or even a floor rate. So we have a little wiggle room to get you the best rate. So for example, our posted 5-year rate is 6.49. I can do 5.89. So when you're talking to a mortgage advisor at the bank, ask them what their base or their floor rate is. And they'll know that and then you can get a better rate. So that's your your weekend hint tip of the day. Okay. Moving on. So now you've picked your mortgage, you know what you qualify for. So let's look at the different types of products that we have available. So banks typically have basically two. We have a standard charge mortgage. This is a standalone mortgage, nothing fancy. The charge decreases on your property as you pay down the mortgage. It's typically amortized between 25 and 30 years. Then we also have a home power plan. This is a branded product. Other banks have things like RBC has home equity line, or Scotia has their STEP program, but basically it's a mortgage as well as a secured line of credit. This acts as a collateral charge against your property. So what that means is we're going to charge the full value of your property against your mortgage rather than the mortgage amount, and it won't decrease over time. There's pros and cons to both sides. The con is that if you have a collateral charge mortgage, it'll look like to other lenders that there's no value left in your home to borrow. So if you needed like a second mortgage or anything like that, it's going to change the loan to value amount that you have available. But the benefit is you can actually restructure your mortgage without having to refinance, pay legal costs, or pay appraisal costs. If you want to perhaps move your secured line of credit into your mortgage, you can walk into any branch and they can do that without any fuss or any additional legal fees or anything like that. And they can use a blended rate. So there's a benefit and there's also a con. If you're looking to get a second mortgage, it might actually be beneficial to refinance that secured line of credit rather than getting a second mortgage. So I do suggest a home power plan. I do like secured line of credits over having a standard mortgage, especially when you're thinking of retirement and going into fixed income. You don't have to reapply for them. They can go up to 65% of the value of your home, and you only pay for what you use. So it is a really good flexible product for when you're on a fixed income or you have a variable income as well, because you're only paying the interest on it, and then you can dump money into the principal when you have it. So that is something to discuss with your mortgage advisor as well, depending on how your income flows during the year too. Okay. So that was my presentation. And for our weekend presentation attendees, if you approach me, I can cover the appraisal for you for any sort of new mortgage. You can also come and we can review your income. I'm not going to pull your credit or anything like that, but we can review your income just to get you prepared for any sort of refinance, renewal, or purchase going on in the future. So you can just reach out to me at my contact information and we can review that anytime. So is there any questions about residential products before we move on to
You're located where, Courtney?
I'm in Kingston. I serve the Eastern Ontario region. So Kingston, Ottawa, Belleville, Quinte, anywhere, basically. I am a mobile mortgage advisor, which means that I work out of my home, I work at the branch, I work at your house, I work at Tim Hortons. So
every solopreneur can relate to that,
right? Yeah.
All
Yeah.
right. Excellent. Well, what we'll do is I want to make sure we give Alex a full 20 minutes if we can. And so we'll make sure to have some Q&A at the end as well. Oh, quick question here. Are there tips for paying off a mortgage? Courtney?
Yes,
Question.
fantastic. So with a CIBC mortgage, if you're on a fixed rate, you have prepayment terms. And this is, you can ask any bank or lender what the prepayment terms are. Our prepayment terms are, you can double your mortgage payment a month. So you can pay up to 100% more per month. And that goes directly to principal, or you can lump sum it. It goes up to 10% for fixed rate mortgages and 20% for variable rate mortgages. So basically the fastest way to pay down a mortgage is to just dump as much money you can into that, the principal part of it. However, there's two sides to a coin. If you have a mortgage and you're dumping all of that money into it, you're also not dumping money into things like retirement plans or investments or things like that. So I would definitely consider both sides of the coin. Using home equity is not a scary thing. It's the cheapest way to borrow. So if you're, so consider that part as well.
Yeah, good to have a financial advisor to look at your all of your
Yes,
objectives as well. So yeah, this is one part of the puzzle. All right.
exactly.
Thank you, Courtney.
Thank
Alex,
you.
over to you. And I will let folks know Alex is feeling under the weather today. So if you watched her sipping her tea. So thanks, Alex, for showing up for We Can today. I know you're not feeling the greatest, but we're truly grateful. So over to you.
Thank you so much. Yeah, I'm so sorry. My voice is not usually this raspy, but I have this Janis Joplin thing going on, so it's all right. We'll make do with what it is, but I apologize if I stop and cough a few times here. So thank you guys for being here today. And Courtney, that was a great presentation. Courtney and I used to actually work together at Citadel back in the day. It was great. We were both on leadership, and she's very knowledgeable in what she does. So it's really nice to be here back, the dream team. Obviously, we do work for different companies now. So a little bit about me. I have an undergraduate in economics and data science. So that's one of the reasons why I became a mortgage broker. I do love the math of it. I am doing my broker's course, actually. You are able to do it after 2 years, but I've just kind of put it off a little bit. So it's been a few years. I do run a team with my broker partner, Angelo. We did actually work at Citadel as well with Courtney. Ask her if you ever get a chance about her experiences there. He's a tough underwriter, but he probably taught me everything I know about commercial and construction and about lending in general. And in the next few years, I would love to own a brokerage. That would be one of my dreams, whether it's with Mortgage Alliance or as an individual brokerage owner. That would be amazing as well. A lot of work for sure, but I am self-employed as well too, so I do understand a lot of the struggles that you ladies face. So some fun facts about me, unique details. What do you guys want to know? I love to golf. I picked it up this year. In my past career, I actually did website designing and SEO and stuff like that. So it is something that has to do with my undergraduate and my postgraduate, all of that stuff. And I don't miss it whatsoever. I don't think I'll ever miss it. I do it for fun for my own business because, when you own a business, you have to be every hat at one point. You got to, be your website designer. You have to be your own financial advisor, at times you have to be your own accountant. So it's something I do for myself, but I really, I don't miss it at all. So I'm glad that I'm here today as a mortgage advisor. So if you've never, not advisor, but if you've ever used a mortgage broker or a mortgage agent, they're one and the same things. A broker can just have a franchise running under them, and they would be principal brokers, so they know the same things, they do the same things. It's pretty much one and the same. So I'll just continue with broker because it's easier. We have access to a lot of different lenders, usually over 60 different lenders, a lot of programs and products. For interest rate options, it really depends on where you are in your business journey, what kind of program you're going to qualify for. As Courtney talked about, there are a lot of different things that you need to have for a lending. And that's always the goal. Now, as I go more in depth about alternative lending, the goal is always to kind of exit onto the A side at some point. It might not be in, the cards at the moment or at the start of the business, or maybe you've hit a rough patch. All business owners do at some point. And the best we can do is mitigate kind of, how hard we hit that rough patch. So it doesn't mean that B lending is a bad thing at all. It's actually a wonderful tool to have in our tool belts as business for self BFS individuals. But eventually you do kind of want to work with a team of people to end up on the A side if if everything works out all right. So like I said, I am a self-employed individual, so we do work with self-employed individuals. So it is nice to be able to relate on that front. So this helps protect your hard-earned money, especially at the beginning when you do have a lot of capital constraints in your business. I will touch on commercial lending, although I could probably talk about commercial lending for the entirety of the hour because it is a lot more complicated than residential lending. But at the beginning, when you do have capital constraints, you can't be hiring employees, you are wearing all those hats, you are having having to kind of protect that money that you have so you can put it where you need it to go. So there are other options aside from banks available. Although it is wonderful to have banks, you have credit unions, you have mono lines, and you do have private lending options. I'm not going to talk so much about private lending options. I'm going to stick more to the Alt A, B side, as we call it, which is generally a mono line, such as First National or Home Trust or MCAP, for example. These are all mono lines, A lenders, and they have a B lending division. And the B lending division is usually a more flexible type of lending division. So whereas on the A side, you're keeping it to 39 and 44 with those debt service ratios, there's some lenders on the B side that allow you to go up to 60-60, for example, Home Trust. Now those are on a case-by-case basis, but generally the good rule of thumb is 45 and 50% for those GDS and TDS ratios, which is something that you know, at the beginning you might be at, because it does take a lot of capital to run a business, and you might kind of, you know, need to pull out some of that money to use for your business, and you might not be able to get a business loan, or you might be refinancing your mortgage and you didn't pay yourself last year enough. And that's where we would need those TDS and GDS ratios to kind of stretch a little bit. And it's wonderful because while you can do a maximum of 30 years amortization on the A side, on the alternative side, there are some lenders that allow 35-year, 40-year amortizations, although 40-year is getting a little bit harder to get to. 35 years, so it does reduce your it does increase your cash flow, sorry, because it'll reduce the payment. And now, like I said, it is something that's more of a short-term thing. So the lending terms, instead of being 3, 4, 5-year fixed, they're usually 1 and 2 years. And I will touch upon that after. I'm the one controlling this. Okay, so basically, like I said, more options for lending. We're trying to protect your hard-earned money in the first few years and kind of build a bubble around that. So then you can call Courtney in a few years and be like, hey, you know, I've done all my taxes. I paid myself all this money. That's great. I can afford it now. And then, you know, you can use your T1 generals, or you can use your T2s for your business after you've incorporated. But sometimes that just doesn't happen from the beginning, and that's okay. And that's why there are still mortgage options for you. And I just kind of want to touch on the process. So exactly like it would be with your bank, we do want to paint a full story. My voice sounds horrible, I'm so sorry. We do want to paint a full story about what your business is, what do you provide, how many employees you have if you do have employees, how many properties you have, all of these things. So we do want to gather all those documents up front. I don't want to have to come back to you 2-3 times asking for documentation. So it's easiest if we do kind of get it all at one time. And then I can analyze it. And because we work with so many different lenders, I can go to the lenders, ask about, you know, if they're willing to entertain the file, if it's more complicated, what that interest rate would be. Are you okay with it? What it would look like for you, and so on and so forth. It definitely does help to have everything up front. And that kind of brings me to my next point about tips that I've learned as a self-employed woman before I get into the actual you know, meat and potatoes of everything.
Alex, can
So
I slide a quick question in here just as you
Yeah.
start this? Okay, so we have a quick question from Jade down here. I don't know if you're going to answer it later, if you want to answer it now. What does it look like when it's time to renew with a B lender after the 2-year amortization? Is it difficult?
I can answer that right now. So the term is 2 years. The amortization, they do 30, 35-year, 40-year amortization. Usually what would happen is when you move to the A side lenders, they would reduce the amortization. It would mean that your payment might look similar to what it actually is with a B lender. But it's very easy. It's very, very easy. All it is a refinance, and we actually take care of that on the back end, so you don't have to. And you know, you can kind of choose your amortization from there, especially on the A side. You have 10-year, 15-year, 20-year, 25-year, you can do 30 years. So if you do make a lot of money after 2 years and you want to pay down that mortgage, you can go down to a 10-year amortization. It's going to mean a higher payment, it's going to mean a bigger payment, but it might actually offset what it looks like, because there will be a slight change in the interest rate as well. It'll be lower on the A side as usual. I'm also going to read how long the mortgage contract is before needing to renew it. Oh, okay, that was your answer. Okay. All right. So good question. And if you have more, please do put it in there, because there is a lot to talk about. So are you going to pay yourself dividends, T4 from your company, depending on what type of company you are, as Courtney already went over? Are you going to pay yourself that for 2 years? Because sometimes we get clients that might have paid themselves a T4 1 year and a dividend the next year, and then we can't T4 average that. So then we kind of have to look at the alternative space, right? And the alternative space, again, does include credit unions. And we do work with like Meridian, First Ontario, Kawartha Credit Union, in Alberta, ATB. There's many different credit unions available in the broker channel, and they're not government governed by OSFI, so they do have a little bit of more flexible type of lending structures. So decide how you're going to pay yourself, and put aside money for your taxes. So if you are going to claim all your taxes with your accountant, please put money aside from it, because if you do owe business taxes on the A side, you can only include, or sorry, personal taxes, you can only include $2,500 in a refinance to pay your CRA. On the B side, they will allow you to pay off, if you do owe taxes, up to, generally, I would say 5,000 is kind of where that limit is. And if you owe anything more than 5,000, we will have to look at a short-term private lending option. I have a client who's self-employed. He owes $47,000 to the CRA. And it's very difficult to get out of that situation with an A or B lender. So it does come with additional rates and fees. So do your best to put aside money for taxes, regardless of whether you're writing things off or not. It is something that we do all have to pay, and it is one of the guaranteed things in life, death and taxes. So we can, put a little bit of money into the refinance to pay those off, but depending on how much it is, it might push you into an area where, you're going to have to take something that isn't as beneficial to you as it would have been had you just paid them. And take that from me, because even as a self-employed person, everybody hates taxes. And at the beginning, I also did forget to do them, and I learned the hard way. So, unfortunately, that's the way it goes. Hire an accountant or bookkeeper. As Courtney said, it's very important that your mortgage advisor, your mortgage broker, and your accountant and bookkeeper and yourself work together to determine where you're going to be and what your income is going to look like, because it's very important to plan. I am going to run through a quick scenario about what it does look like to have an A mortgage versus a B side mortgage, and what your taxes would look like depending on what you're doing. But you do need to have a game plan, and it's easier to start those bad habits, or those good habits at the beginning than it is to try and figure it out 2-3 years, and all of a sudden your mortgage is coming for renewal and you don't have your taxes done, and you don't have this done, and you don't have that done. It's very, very stressful for you. And we want to see you do well, and we want to see you get into a good mortgage term. So it's important to get those done. If you are a business that does have to remit GST, you will have to prove, and I'll show you what documents you'll need, that you're paying this on time and that you've paid it. Very, very important. Set up a budget. You will need a budget, because you will have a personal budget and a business budget. Very important. Again, goes back to an accountant or a financial planner. They'll be able to help you with that. And organize your documentation. So if you're getting invoices, you're going to need those for a mortgage. If you're getting your tax documents, put those away somewhere, because either Courtney or myself are going to ask for them eventually. And it's really important that you have those available so that we can help you get the lending that you need. And then open a business bank account. Very important. Something very, very simple. Don't take from your personal bank account to pay things, especially if you're incorporated. You have to do it in a certain way. And when you're trying to get lending, it's very hard to for us to discover whether it's a business transaction or a personal transaction. And we need that for some of the next options that I have for you guys. So like I said,
Alex, can I?
Yeah. So what type of lender is more favorable for self-employed? So it's really going to depend on your borrower portfolio, so yourself, your level of risk, your income, if you want to, you know, do a lot of write-offs, if you're in a field where you can write off a lot, depends what industry you're in. Restaurant industries are very good for alternative lending because banks do generally have I wouldn't say a negative outlook on them, but they are a higher risk industry as far as seasonality and stuff like that. So it is about meeting with your mortgage broker or mortgage advisor to kind of see what is the best option for you. There obviously is kind of a give up over get in this situation. I have made a comparison chart, so this actually might help answer that question. With A lenders, you're going to have to require a higher declared income on your taxes because in that case, we are using your taxes. And it doesn't matter what, you know, how many deposits you had, etc. Whatever you claimed, that is what your income is. They do have more strict guidelines for lending. 34 and 44, or 39 and 44 is usually a hard stop, although some branches and some banks can kind of increase that when it comes to a conventional loan where you're putting more than 20% down or you're refinancing. But you do have to have amazing credit amazing over 600 is the minimum. With alternative lenders, as most of you know, sometimes you might not have the best credit because you had to use your credit cards to start your business. And it's something that does happen, and a lot of business owners are kind of over leveraged. And so they do allow credit scores from 400 and up. Obviously, in that case, there is usually some kind of rate premium that they do add, usually 0.25%, but it is available if your credit is under 600. A mortgage is not out of the question for you. And again, that's what I said before, it's like a stepping stone. So if that is the main thing holding you back from A lending, then repairing your credit, paying off your debts, you know, with a refi or just working hard to pay off those debts and improve your credit can help you get onto the A side in the future. So a 1 to 2 year term might be, you know, something that you're just going in because you need to repair your credit, and then you're good to go after that, and you can go on to the A side. So it's like another tool in the tool belt when it comes to alternative lending. It's very good for real estate investors. I have a lot of real estate investors that use it because there's also unlimited amount and a number of properties that you can own with some lenders. There's you know, more flexible credit and common sense lending. Stated income is something that is probably one of my favorite programs. It's available with mostly every lender on the B side, and it'll be the next slide, but definitely a lot more flexible than A lending when it comes to things. So there's no fee for using a broker or a branch representative on the A side. I will say that there are slightly higher rates. It's usually about 0.75 to 1% higher in the rate. And there's usually lending fees as well as a broker fee. It's usually about 2% in total. That's added into your mortgage, so it doesn't usually come out of pocket unless it's a purchase. But that is something that kind of varies. Sometimes it's a little bit less than 2%, but usually 1% lending fee, 1% broker fee. And that's just out of transparency. Like I said, on the A side, there is no fee for using a broker or a mortgage advisor. It's just because it's something that has been done forever. Same thing with a credit union as well. And then on the A side,
Alex, when you
sorry.
finish this, I'll slide in a couple questions when you finish your thought.
Yeah, for sure. And the last one is can be insured on the A side, so under 20% down. So you have 5%, you have 20% or 19.9%. You can do insured A side mortgage. You cannot do that on the alternative side. It has to be 20% or more down, especially depending on the property. If it's well and septic, it's going to be a little bit more. And depending on location as well too, if you're in rural Alberta or rural Ontario versus you know, being in Niagara Falls here with me, then it might be something more like 25 or 30% down. So it is a lot more of a down payment if you are purchasing. Okay, I'm ready for the question.
All right, so I'm going to start with the most recent one, but I wrote down the other one, so don't worry. If you put one in there, I'm going to hopefully get to it. If not, we'll do it in the end Q&A. Are credit unions B lenders? Aren't they insurable mortgages is the question.
So credit unions are a little bit outside of both mono lines and B lenders. They exist kind of on their own. They're regulated in a complete different way. Mono lines don't have deposits, so you can't go into a mono line bank because they usually don't exist in a brick and mortar section and deposit your money and get, an interest in return or use it as a bank card. Credit unions do have deposit accounts. And they do have insured products, but then when it comes to uninsured products, they are very flexible because they kind of make their own rules, right? So Scotia, for example, their conventional mortgage products are still going to be kind of rigid and structured to the OSFI guidelines, where a credit union is a little bit more laissez-faire sometimes. In the past, if you had a good relationship with your credit union advisor, it's not so much anymore, but so they are a little bit more flexible in that sense. And then a B lender is kind of like a credit union, but they're owned by the mono lines generally. Some of them aren't, but they have a complete different set of rules. They pretty much can make their own rules, and they take money from investors. So did that answer the question?
I'm not sure, but Stacy, you can make a note in the Zoom chat.
Yeah, Stacey, did that answer the question? Okay.
And I have another question about A lenders and B lenders. I think this one was from Jade. Do you ever renew, sorry, read this. Do you ever renew a mortgage with a B lender to go to another B lender, or do you have to go from an A lender or to an A lender after a B lender? I just want to say blender because that's what it looks like to me, blender. Do you have to move, I guess laterally, or how does that work?
No. So a lot of the times with my clients, especially if they have like debt consolidations, bankruptcy, something like this, sometimes we'll go from private lending or B lending. And there's, like I said, always an exit strategy. So you do always want to move private to B to A. That is always the goal. When anything debt consolidation or credit challenges or income is involved. So you can renew your mortgage if you're with a B lender. We can do another B lender mortgage if they're offering better terms and rates and whatnot. I've done that in the past, move from Home Trust and we go to MPX or something like that, because sometimes people do stay with B lenders. But no, it doesn't have to be, and the same thing can happen too. You can be with an A lender and then something happens and you got to go backwards, right? So no, it's not like you're stuck with one lender forever, and you're not stuck with one type of lender forever.
Did that help, Jade? Okay, I saw the thumbs up. And then quick question here also that I jotted down. Which type of lender is more favorable to the self-employed? If you could, is there one?
Alternative lenders are. I'm going to explain this program because the stated income programs is probably the most favorable as far as lending goes for business for self. I'm a mortgage broker, so I do make commission. I'm not a stated income. I'm not selling a product or a good or service. But for those who do sell a good like products and whatnot, or do have services where they don't make commission, this is probably the bread and butter of a lot of my clients who are self-employed. Like this is how we, get them mortgages. So with a stated income, this is basically telling the lender, and it is a fully legal, acceptable way of doing it, how much money you make without showing your tax documents. Now, we usually do ask for tax documents to better understand the picture. If you do have your tax documents done by a CPA, you don't have to have them for this. It's nice to look at the financials and see kind of what's going on and what expenses you have declared, because it does help us with some of the documents. But all we're going to ask for is 12 months of bank statements. Used to be 6, it's now 12. And then I use a handy dandy little calculator, and then I take all your deposits and then add those up, and we annualize it over 12 months. So all those 12 months, I'm taking those deposits, and it basically kind of spits out a total income for the year. So for example, a restaurant owner I had, the annual income was about $500,000. Did he make $500,000? No, he didn't, because there's a lot of expenses. So then we will remove some expenses and we will do a statement of declared income for the lender. A lot of that I figure out, and then we kind of just work through it together. Like, how much on average do you spend on meals and this and that, and you know, paying your employees, how many employees do you have? But it gives the lender a number, and you just sign a document that states that this is my income, and this is you know, this is what basically I'm making. It's a wonderful program, especially if you're in the restaurant industry, especially if, you know, you're just starting out and you haven't done your taxes with a CPA. And they will look at people who are just 6 months in business. That's the minimum. But if you're under that 2 years of business, you don't even have a 2-year average to use to go to a bank, right? So you are, if you do have more than 20% down and you do want to buy a home and you haven't declared your taxes, then, you know, a stated income program for 1 or 2 years until you get to the A side is going to be your best friend. So if you are on commission like me, we're going to use a year-to-date commission statement and kind of, you know, see what you were doing last year and what you're doing this year. But we do want to see your GST statements. You can be incorporated, but you don't have to be incorporated to do this. It does help though if you do have a business bank. And that's what, going back to what I said earlier, if you have somewhere that we can look at all the deposits and know that they're business deposits and send them to the lender, it makes a huge difference, because not only does it show that you have a separation and that you can move in the future towards a lending because you're organized and ready for that, but it also, you know, just makes it easier for us, and then we're not missing anything and, you know, seeing all your Walmart purchases and this purchases and that purchases, unless, you know, it's for business. I am going to kind of compare this. I know we're running a little bit out of time, but can everyone see both sides of this? It's a little hard to see, but because of the gallery. But so scenario 1 is going to be an alternative lender. So say, for example, you have business revenue, and this is your claimed business revenue, and this is your taxable amount on your personal taxes, $30,000. Your accountant has written down a lot, and now you're left with $30,000. That's enough to qualify for a $120,000 mortgage, right? Not enough in most places that we're here for. So income tax payable, you're in a 15% tax bracket. It's going to be around $375 a month. For an alt A lender or B lender, your interest rate's going to be a little bit higher than the A side. We're going to say 6.57. Your monthly mortgage payment is going to be $3,186.84. So again, going back to your income tax pay, I don't know why that doubled there, but now we're going to go to scenario 2. So your business revenue is $80,000. You claim $10,000 of business expenses, and you paid yourself $70,000. Your income tax payable is going to be about $1,197.92 a month, because you're in a 20.50 tax bracket. Your mortgage rate is going to be 5.49, and your monthly mortgage payment is going to be $2,833. In your scenario 1, this is the alt lender, your total monthly expense is around $3,561, including your income tax and including your mortgage payment. In scenario 2, your monthly expense is about $4,330.99. So it does save about $469 to be with an A lender. In this case, given that the mortgage rate is higher. I will say this doesn't take into account the lending fees, which are added into the mortgage. But for some people, this might be a better place because it allows more money to be in your pocket. And then in the future, when you're making more money, you can claim more on your taxes and move to the A side, because don't forget, being on the A side and the bank side does open you up to other opportunities to have a relationship with your bank, and they will offer you, you know, other lending solutions and stuff like this. So it is just, you know, kind of something that we use it as a transitory method. So 1 to 2 years, you're maybe doing this, you don't have an accountant, or, you know, you're not doing your CPA financials. It will save a little bit of money to be with an alt lender, depending on what your situation is. But I don't recommend it forever, just because every 1 to 2 years having to redo your mortgage is going to be something where at the end you are paying a lot in fees and you are paying a higher interest rate, and you're not able to shrink that amortization lower than 30 years. So it's going to take a little bit longer to pay off your mortgage. So just keep that in mind. Although the numbers do look fantastic, it is something that we use as a tool in the moment for 1 to 2 years. And then you want to be calling Courtney, because at that point, you don't want to be, paying the fees forever. And you don't want to be writing down your taxes forever, because as much as it's great to write down, like write off everything, you're going for dinner, et cetera, it isn't great to do. It is something that we all do, and I'm guilty of it as well too. But I would also be, my first mortgage is with Meridian, and my other mortgage is with Manulife. They do have a good small business program. They are an A lender, so it's a little different. But my next mortgage would be with a B lender, just because of what I do now for work and how I do write off my taxes. So it's not something that it's like, oh, she's a mortgage broker, she should be A side. I do the same thing. I'm guilty of the same thing as a small business owner, as a self-employed person. So it's just making that team and deciding what's best for you.
It's true. I work for a bank and I would have a B lending mortgage. So like it's not a horrible thing.
No,
Fact
they're
of life.
great, like super reliable lenders. And they are wonderful to work with on our side and on your side. And they are understanding. You have to understand that when it comes to lending, there are spaces like us behind those screens. It's not the big bad bank. And especially when it comes to common sense lending, they do think about it like, okay, if you've been through credit challenges, if you've been through something with your business, or COVID affected it, or this or that, they do look at you as a human being. So take that idea that everybody is super scary at the bank out of your brain, because generally we do want to help you. I mean, there's people here and there that don't, but don't let that scare you. Before I talk about commercial for 2 seconds, I know we're running out of time, I'm sorry. Mortgages for Indigenous women. So it goes the same like Courtney as well. So we can gross it up. If you are stated income, then we don't have to worry about grossing up your income tax, but we can use tax documents on the B side. We just don't like to, because you can afford more without using them and doing a stated income. So you are going to be able to do under 30,000, maximum 25% gross up, and then over 30,000, maximum 35% gross up. And we do have lenders that will look at leased land. If you aren't an Indigenous person, but you're buying on leased Indigenous land, or if you are an Indigenous person and you do want to buy on leased land, we do have options for that as well. A little bit more difficult. So everybody has to work together on those, but don't shy away from them, especially if you have questions about them. I would love to answer them. So I'm going to quickly talk about commercial mortgages. Commercial mortgages are a whole different beast. Very, very different than residential mortgages. So it includes retail spaces, office buildings, industrial buildings, multifamily buildings. When it comes to commercial mortgages, they don't look at your income and credit the same way that they do on the residential side. They're going to see that the main thing is actually the property. Is the property able to debt service itself? So if you're getting rent in that building, they want to see a rent roll when you're trying to purchase it. Who's already there? What kind of business is there? Because if you're buying, again, restaurant, I hate to bring it up, I love to eat, so it has nothing to do with restaurants. But if you're buying a restaurant, again, it's going to be a lot harder to finance, and you're going to need a lot higher of a down payment than you would if you're buying a multifamily with affordable housing or something like this, or a strip mall that has multiple different businesses. But I would highly suggest connecting with a commercial mortgage, commercial realtor, because there are options before buying that you can lease. The leases on the commercial side, this is not something that I do because I'm not a realtor, but I do want to talk about triple net leases. Triple net leases are something that, instead of it being like a residential mortgage, residential lease where the landlord is responsible for everything, you are responsible for everything in a triple net lease, which is a commercial lease. If the air conditioning goes, if you need to rip out the floors to change something, if you need to fix the plumbing, this is all on your bill when you leave. I have a client, she's a dentist. They bought a dental building, but they rented for 14 years somewhere, and each office had its own ventilation, and the landlord is requiring her to rip out everything, and it's a cost of $100,000 to rip out everything they put in because it needs to be returned in pristine original condition. So if you are just renting and not buying, please have a commercial realtor review your lease and know that if you move out, you're going to have to return it to original state. So this is something that's very important. It has nothing to do with mortgages. But if that's the first step in your commercial buying journey, please talk with a commercial realtor. When it comes to commercial mortgages, you're going to have a higher down payment. We do work with banks, First National, Laurentian, National Bank, CMLS, all of these, they're actually monolines. They're A-side lending, B-side lending, again, Home Trust, Equitable, they do offer commercial mortgages, and anything that's mixed use or zoned commercial or industrial, those are going to be commercial mortgages. So it doesn't matter if the property is 50% residential, 50% commercial, you're not going to get a residential mortgage for it. It's going to be a commercial. If you talk to someone who says that they can do it residential, please don't listen to them. It's not going to happen. It's never going to be the case. It would be lovely if it was, but it's just a lot of runaround for the fact that it won't be that. If you are buying commercial space, do know that commercial properties do have higher appraisals. So you're going to be looking in the $1,300 to $3,000 range. There's always going to be a lending fee, whether it's A side, B side, or private. It just depends. It starts at 1% for the A side, and that's even whether you go in the bank or not. There's always going to be a fee, and then it can go all the way to 3-4%. So it is a lot higher of a down payment. You're going to need a lot more of your documents. You're going to need your tax documents. You're going to need the rent roll from the business you're purchasing. So be prepared for a very involved, long process. They can take 3 times longer than a residential mortgage. And then lastly, lender choices may be limited. So if the property does have like a gas station on it, or industrial warehouse or industrial strip mall, you might need an environmental study, and there's 3 phases, and it could cost anywhere between $5,000 and $200,000. It depends how far you get there. And if you get those results and they're not favorable, your lender choices are going to be a lot more limited. So do your due diligence when you're purchasing something that's commercial. Understand that there's going to, that you're going to be in it for the long run, and make sure that you're structured well legally, accounting wise, and at the end of the day, it is a great investment to have a commercial mortgage and a commercial property, but it does look a lot different than residential. So you can download my app. It's mopolo.ca. If you do want to do it, it does let you track your free credit score, and keep track of that. I am going to cut it off there. So there's my information. Sorry, I went over a little bit, and I will answer questions quickly, but I could honestly talk about this for like 10 years. So
I think you and Courtney are so passionate about this, but I love it. And it's I know there's been maybe one that's only dropped off so far. Of course, it's recorded, so anyone that misses the end can pop on. For those who are able to, I have a couple more minutes if there is a burning question. I know we've been answering throughout. Thank you to both of you. Is there another question that someone might want to drop into the Zoom chat, or just say me, if it's something that you want to slide it in? And I'll just preface that with, of course, you have the email addresses for Courtney, who has hers in the Zoom chat. Maybe you want to put one more time in the Zoom chat, Courtney. And then there's Alex's right in front of you there as well. Highly would recommend following up if that's something that's of interest to you, for particulars.
I'm going to just answer Stacey's questions. Are there any grants for women in business? I do business loans, although I would highly recommend either going to your bank or searching online for grants. There are a lot of grants, and I'm sure that we can help you with those as well. Also reaching out to your local BDC is also a good thing to have a relationship with someone there, if someone that we can, or a mortgage agent or something like that can help you. Or sometimes if you can't get a grant, or a loan, then if you do own a property, sometimes it is good. You can take it from your property. It will be a lower interest rate, but I wish there was more grants available. It is not easy to get a grant, unfortunately. I'm on the
Are
board of
these
directors of
grants to
Crime Stoppers.
purchase homes?
Yeah,
A
Grants to purchase.
BDC?
yeah, that was the question. Are there any grants for women who are interested in purchasing property?
Oh, okay.
Yeah. That's okay. Yeah,
There
there's-
are, depending on your income, there is a lot of grants available. They do have a wait list, and they do have a lot of restrictions depending on your area. There is one for Indigenous people in I mean, for sure in Ontario. I know that they do have them other places, again, waitlisted. But if you can get in and fill it out, there are options there. I don't think you do have to have status, so I don't think you have to be a status native, which is something that's very important, because it takes like 2 years. My mom's side, my mom does have status, but I don't. So I personally don't need it, but I know that I have tried for clients to get it, but it's not easy. So check in your area. There might be a contact at your local like friendship center or something like this that can help you with that.
Perfect. Jade?
I had a quick question, if that's okay.
Yeah.
If you have a home with a HELOC currently, and are you able to leverage that HELOC as a down payment onto an additional property? I know it probably
Yeah.
makes more sense when you have specific numbers that you're looking at right in front of you, but I was just curious, like, what that process would look like in general, if that's available.
So basically, we would just pretend as if you had used that HELOC and debt service it into your numbers. So you can absolutely use credit to buy another house, but we have to debt service it.
That's awesome.
Yeah.
Thanks.
I'm
That was
also
that was my new
course,
acronym of the day, by the way. Go ahead, Alex.
Yeah.
I'm also gonna send you, Carrie, I'll send I have a separate commercial presentation that you can also look over. And if you have any questions, everyone can reach out to me. There's just so much to talk about when it comes to commercial,
Yeah.
that like 2 hours isn't enough for commercial, just because there's a lot of acronyms, and there's a lot of acronyms for there for you, Carrie.
Go ahead,
Learning experience.
Courtney. Did you want the last word today?
No, that was a
Oh.
great presentation. Yeah, commercial is a huge beast. Banks do commercial loans as well. It's just not personally my forte, so I let Alex talk about that. So that's
Well,
great.
the two of you together are a dynamic duo.
Thank
So
you.
great to see, women who network in their previous jobs, and now you've come forward and you're co-hosting this workshop. We want to thank you so much for doing that for us today.
Thanks, Carrie.
And everyone has info if they want to follow up with these two brilliant minds. I've also written down 2 additional weekend workshops, which we'll be doing in the future, that have come out of this, that don't really have to do with mortgages, but that have, significance for our community. I did put a note into the Zoom chat, folks, for what's coming up next for our weekend workshops. Of course, if you're already on our email list, then that is the best way to find out exactly what's happening. And if you're not on that weekly email news digest list, you have my email because I sent you the link for today. Just email me back and say, hey, please put me on that list, and we'll make sure that you never miss a beat. All right. Thank you so much, folks. And thank you again to Alex and Courtney for sharing their wisdom today. Truly appreciate it. Great session. Thanks, folks. Have a great day.
Thanks.
Bye now.
Bye.